Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a video update on Friday, August 4th, 2023. This morning's jobs report for July came as welcome news on Wall Street. Last month, the U.S. economy added 187,000 net new jobs. That was less than the 200,000 figure widely anticipated on Wall Street and far below the monthly average of 312,000 over the past 12 months. At the same time, the unemployment rate fell to 3.5% from 3.6% the month before. And here's the press release here that you're looking at on your screen. Not much excitement here, but the 3.5% unemployment rate, I think, is a little bit of a concern. Also, another fly in the ointment was a 0.4% monthly increase in average pay, which means wages are now rising at a faster pace than inflation. That's not necessarily a huge problem, but if that trend continues, then that could exert inflationary pressure on retail prices. In other words, people are making money faster than the prices of goods are going up, so over time they have more buying power. In theory, slowing job growth should suppress wages since employers do not have to pay higher salaries to attract and retain workers. I do not think this report is encouraging enough to dissuade the Fed from making or to dissuade them from making a 25 basis point interest rate hike at its next policy meeting in September. However, if next month's jobs report for this month shows wage growth slowing down, then another rate hike may not be necessary. The bond market seems to believe that higher interest rates are on the way. After the jobs report was released this morning, the yield on the 10-year Treasury note spiked above 4.2%. Just 2 weeks ago, it closed below 3.75%. The yield curve is now fully inverted with the 3-month Treasury bill at 5.4%. In short, the bond market is still expecting a recession triggered by higher interest rates this fall. And here's just a chart of bond yields as of this afternoon, and you can see the Treasury securities with 1 month remaining are almost at 5.4, and pretty much 5.4-ish is the rate all the way through 1 year. And then it starts to come all the way down to just under 4.1 at 10-year before it creeps back up. But the equity markets begs to differ. All of the major stock market averages have gained ground during the past month and are up considerably this year. Even after last night's somewhat disappointing quarterly report from Apple, the S&P 500 and NASDAQ composite indexes were posting gains this afternoon despite a 3% drop by Apple, which is the single biggest component of each. Remember, those two indexes are cap weighted. Apple is the most valuable publicly traded company in the world, so it has the most influence of any stock over both those indexes. And in fact, just now the S&P 500, well, the S&P just turned slightly negative. NASDAQ still positive. So even though Apple is down, at least as I'm speaking to you now, at about 3.8%, it hasn't dragged down all of the entire stock market with it. That's a good sign. It means indexing is no longer the tail wagging the dog. Instead of simply pulling money out of the stock market, investors are putting that money into other companies that are posting better operating metrics. That is how a healthy stock market is supposed to work. All of that is happening against the backdrop of rising oil prices. The price of a barrel of crude oil has increased from below $70 a month ago to above $83 today. That is the highest it has been since last November, suggesting that the recently enacted OPEC production cuts are having their intended effect. So here's a year-to-date chart of oil prices, and you can see it's actually kind of trending down all the way here until about the end of June, and where it was below $68 a barrel. So really over the past 6 weeks, oil prices have increased roughly more than 20%. The potential impact, the impact of higher fuel prices is apparent in the performance of the U.S. Global Jets ETF, since fuel prices is by far the biggest variable cost for most airlines. Over the past month, Jets has lost nearly 10% while the overall stock market is up. Now, here's a chart of Jets, and if you look at its top holdings, it's exactly who you would guess they are: Delta, American Airlines, Southwest Airlines, United Airlines. And all of those companies use a tremendous amount of fuel. Now, they hedge that somewhat in the futures market, but nevertheless, higher fuel prices do cut into their operating profits. If oil prices go much higher, we may see other sectors of the stock market start to sag under the weight of rising fuel and transportation costs. So that's something really just to be watching for here over the next couple of weeks and months. So that's today's PF video update, and I look forward to talking to you in another week. Thank you.